The market is closed for SoFi Technologies Inc., SoFi. The last reported closing price on Friday, October 10, 2025, was $26.19, with an after-hours price of $26.48, representing an increase of 1.14% from the close. This single-day price action, while seemingly unremarkable on its face, hides a critical and deeper institutional maneuver that many retail SoFi investors are missing. A subtle yet significant shift in the quality of institutional ownership, which is far more indicative of long-term stability than the simple count of institutional holders. Everyone talks about the dramatic Q2 earnings beat, the 44% year-over-year adjusted net revenue growth, and the impressive membership numbers, believing that these headline figures alone are enough to carry SoFi stock higher. However, the more complex reality is that the stock's future hinges less on its next set of member additions and more on its continued success in replacing volatile warehouse funding with its own low-cost, sticky bank deposits, a metric that underlies all its profitability targets and which truly differentiates it from competitors like Robinhood or even the lending arms of major players like Fidelity or Interactive Brokers. The common investor narrative around SoFi focuses entirely on the super app vision, the idea that it's building a one-stop shop for all personal finance needs, blending lending, cash management, and online investing through SoFi Invest. This narrative is correct, but it sets up a false expectation. The market believes growth is simply about acquiring more members. The deeper truth is that the value creation comes from increasing the average number of products per member, a metric the company calls its financial services productivity loop, and, critically, doing so profitably, which requires the bank charter to lower the cost of funds for their lending business. The recent price turbulence, which saw the stock trading in a wide intraday range of $26.13 to $29.80 on Friday, reflects this tension, a constant battle between growth optimists and skeptics who worry about valuation multiples and the persistent need for the company to raise capital, even after achieving several quarters of GAAP profitability. When you look at the short-term trading patterns, the SoFi volatility is a trader's plaything, driven by options volume and technical levels, but the long-term trend, up over 220% in the last year, is entirely due to the successful execution of this full-stack financial services model. Breaking down the recent stock movement, the dramatic post-Q2 earnings spike of nearly 18% proved just how sensitive the stock is to profitability and guidance. The 0.08 adjusted EPS beat against a consensus of 0.06, paired with raised full-year guidance for revenue, EBITDA, and EPS, was the textbook catalyst. The market was expecting a good quarter, it received a great one, validating the path to sustained profitability. However, since that high, the stock has experienced notable selling pressure, falling from its 52-week high of $30.30. This decline isn't necessarily a sign of a broken growth story, but is more characteristic of a high-growth name experiencing technical selling after a massive run, coupled with broader market apprehension around rising interest rates and their potential impact on loan quality and growth. This is where the institutional activity becomes enlightening. Recent 13F filings show a clear institutional accumulation trend, with over 1,000 institutions holding more than 50% of the shares outstanding. Firms like Vanguard and BlackRock hold massive positions, and while these are largely passive index-tracking funds, the significant additions from quantitative hedge funds like Valorage Investment Management and Jane Street Group in the most recent quarter signal a sophisticated strategic interest. These are institutions that analyze the underlying technology and financial engineering, not just the surface-level member growth. The fact that a large number of institutions increased their positions, 433 holders increasing versus 292 decreasing, indicates a net accumulation, which is a powerful vote of confidence in the underlying business stability despite the price volatility. This inflow of smart capital provides a stability anchor the market often overlooks when focusing on daily price swings. The core of SoFi's business model is its differentiation as a tech-enabled financial services holding company with a national bank charter. Unlike pure fintech apps like Robinhood, SoFi controls its lending economics. It uses its bank charter to gather cheap deposits, which provides a far more cost-effective funding source for its personal, student, and home loans compared to relying on expensive warehouse lines or selling loans immediately. This is the whole reason they are able to achieve positive GAAP net income and boast a 5.86% net interest margin. The business is segmented into three parts: lending, which is historically strong but rate-sensitive; technology platform, Galileo and Technesis, which provides back-end payment processing and digital banking infrastructure to other financial companies globally, creating a high-margin, sticky revenue stream; and financial services, like SoFi Invest, SoFi Money, and insurance products, which are designed to capture members early and push them into the higher-margin lending products. The synergy between these segments, the financial services productivity loop, is what creates value. For instance, when a user signs up for a free checking account on SoFi, they've entered the ecosystem and are now a prime target for a high-margin personal loan or a future mortgage. This cross-sell mechanism is the true intellectual property of the company, and its success is evidenced by the consistent, rapid growth in products per member. This strategy is a direct competitive response to traditional wealth managers and brokerages like Fidelity or Schwab Intelligent Portfolios, aiming to capture the tech-savvy younger investor base who prefer a unified digital experience. Historically, SoFi has been characterized by extreme volatility, largely due to its high growth and reliance on the lending segment in a fluctuating interest rate environment. The lifting of the student loan moratorium was a substantial positive for its student loan refinancing business, which had been dormant, and the sheer volume of personal loan originations has repeatedly surpassed expectations. The shift to GAAP profitability in recent quarters is arguably the most important past performance indicator, as it moves the company from a speculative growth investment to a proven operating business. However, the consistent insider selling observed over the last 6 months, multiple large sales from key executives, is a reality check that the market has to absorb, serving as a psychological headwind against bullish momentum. The counter-reality here is that CEO Anthony Noto retains a significant stake, and his bullish commentary on the company's future, even stating after the Q2 report that this is the worst we'll ever be, provides a strong counter-narrative to the insider sales. Looking ahead, the next major catalyst is the Q3 2025 earnings report, confirmed for before market open on Tuesday, October 28, 2025. The expectation is for another solid beat, given the raised guidance. But the reality that will be scrutinized most closely is the growth and margin in the two non-lending segments, technology platform and financial services. Specifically, investors need to see fee-based revenue continue to grow at a faster clip than lending revenue to prove the diversification model is working, especially in a higher-for-longer interest rate environment that slows loan growth. Another crucial catalyst is the expansion of the technology platform Galileo. Every new partner Galileo signs, particularly outside the US, adds a highly predictable, high-margin money flow that insulates SoFi from domestic credit cycles. If Galileo can secure several high-profile contracts, that will fundamentally change the valuation calculation for SoFi stock. The risks, conversely, are centered on credit quality. As interest rates stay high, the risk of defaults in their loan portfolio rises. A surprise uptick in loan loss provisions would immediately derail the current profitability narrative and reintroduce skepticism. The opportunity for investors lies in the market's tendency to still treat SoFi primarily as a lending business when it is in reality a digital infrastructure and bank holding company hybrid. Continued execution on cross-selling and further consolidation of deposits through SoFi Money will eventually force a re-rating by Wall Street, where the SoFi investment thesis begins to look less like a personal loan company and more like a high-growth version of a diversified financial giant. The stock's technical setup shows that the $26 level is a significant psychological and technical battleground. Breaking substantially below that could trigger more systematic selling, whereas a strong earnings report pushing it past the $29 resistance would signal a retest of the $30.30 high. For those engaging in self-investing, the technical volatility means that entries and exits need to be carefully considered around these key price levels. The long-term picture, however, demands looking beyond the daily tape and concentrating on the fundamental reality. SoFi is successfully building a flywheel effect driven by its bank charter, high-tech platform, and expanding product suite, making it a powerful contender in the consumer online investment and individual brokerage space, competing directly with established names like Fidelity, while offering a modern experience similar to Robinhood trading. The recent launch of additional trading products such as options trading on the SoFi Invest platform is an attempt to close the product gap with competitors like Robinhood stock trading and offer more tools for the sophisticated self-investing user. This feature expansion is key to driving engagement and retaining those members who might otherwise split their investment activities across different investing sites, using SoFi for banking and a dedicated app like Interactive Brokers for active trading. The overall trend here is clear: to be the primary financial relationship for its members. This push into more complex trading is a critical step in that direction, even as it increases competition with platforms that specialize in options, like the more advanced Interactive Brokers trading platform. The question remains whether SoFi can attract the high-volume active trader without cannibalizing its brand as a responsible low-fee financial partner. This subtle strategic balance, maintaining the image of reliable investment help while offering high-volatility products, is a tightrope walk for CEO Noto. The institutional support, which is often seen as a rubber stamp, is actually a complex layer of protection and validation for SoFi. The increased presence of growth-focused institutional investors suggests a